Well, good morning, everyone, and thank you for joining us to the NCVO and CFG joint webinar on financial management during COVID-19. My name is Richard Sagar. I'm Policy Manager here at the Charity Finance Group. We're also kindly joined by Elizabeth Chamberlain from NCVO, two speakers from the Charity Commission, and Nazir Hashemi from Audit Partners Crowe. Before we get into the main section of the webinar, I'll do some brief introductory slides and then pass on to my colleague Elizabeth to speak through some of the context, and then we'll get into the main things around financial management during COVID-19. But before I get underway, I want to double check that people can both see and hear us. So please do type in the chat box on the right hand side if you can both hear me and see the slides in front of you. It takes a second or two delay between me speaking and you hearing it, so I'll leave a second for you to type that now. Looks like people can hear me, which is good news, so I'll proceed to get underway. So yeah, one or two bits of information here which may be useful, including some links for you. And this is the overall government guidance around financial support measures for voluntary community and social enterprise organisations in responding to COVID-19. If you click on the link below after the presentation, of course, it will provide you with all the relevant guidance around the different pots of money that are available from government. So again, I'd suggest you do look at that in your own time to see what you might be eligible for. And the major of these, of course, is the Coronavirus Community Support Fund announced by the government on the 20th of May by Secretary of State Oliver Dowden. Now, it should be noted that both NCVO and CFG are doing another joint webinar in a little while into the future, looking at how one might apply for these funds with the National Lottery Communities Fund. So please do stay have your eyes peeled for that, but here is the link that provides a bit more information in the meantime for that. And finally, this is a really useful tool that the government have announced, and it's the Coronavirus Support Finder. So of course, government have announced a number of business support measures, including the Coronavirus Job Retention Scheme, a number of loan schemes and some retail grants. And if you fill out this brief set of questions, it will be able to direct you to which of these you may be eligible for, so you can apply. We won't go into too much detail at this stage around those schemes, but perhaps that will come in to questioning later. And that's my very brief introductory slides. I'm going to pass on to my colleague Elizabeth from NCVO, who will talk through a bit more context around the policy work that we've been doing around COVID-19. So Elizabeth, take it away.
Thank you, Richard. I think it's really important to be having this webinar about financial management at this time, because over the last number of weeks, there's not a single charity that hasn't expressed their concerns about their financial situation and how they're going to manage the challenge over the next 6, 9, 12 months. It was clear when the Chancellor announced the package of 750 million that although this was welcome, it would not be enough to prevent good charities from closing the doors. And we know now that even many that will get through the crisis will probably look very different in a few months' time, with severely reduced capacity to provide support. It's also worth noting that this 750 million is not a bailout for income that has been lost. It is specifically about supporting organisations that are experiencing additional demand on their services during the crisis. So it's not available to organisations that are not deemed to be in the front line of responding to the crisis. And this was confirmed last week when the National Lottery Community Fund opened applications for the 200 million that it is distributing and set out its eligibility criteria. So if you look at the eligibility criteria, it's very obvious that the types of projects and organisations that are prioritised are organisations supporting people and communities who experience a disproportionate challenge and difficulty as a result of the COVID crisis, organisations that are providing services and support for vulnerable people, for which there will be increased demand as a result of the crisis, and organisations that connect communities and support communities to work together in response to the crisis. For the rest of the sector, probably for a great part of the sector, one of the most important sources of support has probably been the job retention scheme. We've heard about many organisations making use of the scheme, but that doesn't mean that it can be problematic. For many, it feels like a rather perverse incentive that charities are furloughing staff at a time when supporting the most vulnerable in society is needed more than ever. We also know that the Chancellor has obviously announced an extension of the scheme until the end of October. This again was very welcome, but there are some questions about the changes that will come into effect from August, particularly what the employer contribution is expected to be in order to continue to meet the 80% salary cost. As Richard mentioned earlier, there are also a number of business financial measures for which charities are eligible, and these will be helpful to some. But when they were first announced, they did include some sort of design and structural features that were restricting the ability of charities to access the financial support. So NCVO worked with CFG and the Charity Tax Group to propose a series of amendments that would make sure the schemes would work better for charities. So, for example, we suggested removing the 50% trading requirement for the coronavirus business interruption loan scheme, and expanding the definition of eligible retail, hospitality and leisure properties in the Retail, Hospitality and Leisure Grant Fund, so that community buildings would be included. The government has responded positively to some of these changes, but it's likely that the financial measures, as I say, won't be suitable for everybody. So as I say, for some organisations, furloughing staff at the moment remains just about the worst option because demand has actually increased. And for example, the various forms of loan finance are viable and suitable for a relatively small proportion of the sector. The other issue is that none of this will address the medium and long-term financial challenges that the sector is facing. The reality is that charities spend up to 12.5 billion providing services to people each quarter, and they are likely to have lost a quarter of their income. As social distances continues in some form or another to remain in place, it's not entirely clear when income will return, and obviously it won't make up for the loss that has been experienced in the meantime. So the longer term financial situation of the sector is a huge concern, and that includes our larger charities that are not benefiting from any government support. We've already seen over the last number of weeks how even some household name charities such as the National Trust and St John's Ambulance are having to make some really difficult financial decisions in order to ensure they can continue to operate sustainably. So I think the guidance and the advice that we'll be hearing in this webinar from the Charity Commission and from Crow will be hugely helpful.
So thanks very much for Elizabeth providing a really useful context there of not just the impact that on charities, but also what we as sector bodies have done to try and support those in need during this time. One or two questions have come through around some housekeeping, and so I'll just respond to those very briefly. Firstly, to say that all sessions are recorded and you'll be able to get a recording of those after it finishes. And in addition, all slides will be sent to participants as well. So don't feel too panicked about having to make really quick notes. We'll quickly pass on now to Nigel Davis from the Charity Commission, who will give a presentation, and then we'll quickly go on to questions that his colleague Jenny Stewart will be able to address as well. So if we quickly pass on to Nigel's presentation now.
Hello and welcome to this COVID-19 update from the Charity Commission. My thanks to NCVO and Charity Finance Group for the opportunity to present on this topic to you today. I'm Nigel Davis, Assistant Director of Accountancy Services at the Charity Commission, and I lead the team of accountants who assist the Commission in its work in terms of cases and development of advice and guidance on financial issues. In terms of the update today, we'll be looking at three areas. Firstly, where the Commission can help using our powers. Secondly, relevant advice and guidance which we've issued. And finally, I'll close with developments which were in hand at the time of preparing this talk. The Commission is extremely aware of the difficult and challenging circumstances that the sector is facing, and consequently we would wish to play our part in assisting the sector through these difficult circumstances. We have been and continue to be open for business to assist the sector and indeed the public with any issues that arise. So where can we help? Firstly, in terms of filing, charity law sets out the filing requirement, and the requirement is to file with us within 10 months of your financial period end. I'm afraid this is set out in law and it's not in our gift to change it. What we can do is be flexible in our approach. So if you're aware that there's a filing difficulty with your charity or your charity clients, please do get in contact with us as soon as possible using the dedicated email address, giving us the relevant details. For charitable companies, you also have to file with Companies House. The circumstances here are slightly different as they have been extended a discretion in law to allow a deferment in filing for I think up to 3 months. But do look at the Companies House website for more information. In terms of dealing with matters electronically and hosting meetings, the growth of Zoom and other platforms has shown the power and flexibility of video calls and similar fora for meetings. Your charity's governing document will permit you to use these in place of physical meetings. If that's not the case, do look to see if you can amend the governing document, or if that's not possible, then we take a very flexible approach, as you can see. As long as you record the circumstances and the reason for your decision, then we'll have no difficulty with it. In terms of spending money and being able to support the wider community and beneficiaries through the difficult time, in most circumstances, the resources should be flexibly enough defined that you're able to apply them effectively. But if you're in circumstances where either due to restrictions on a particular set of funds or alternative due to restrictions in the charity which limit what you're able to do, then you may need to contact us to see how we can help. If there's a reasonable case and we can help, then we'll look to do what we can. But in most circumstances, we anticipate that charity objects will be sufficiently broad to accommodate dealing with issues arising from COVID-19 on your beneficiaries and community. Our advice and guidance. We have a dedicated page for advice and guidance with a number of topics on there. I've covered off a couple of those already. And in terms of serious incident reporting, we encourage reporting through this period, not just around safeguarding, but also in terms of other issues that may arise, where we are aware of issues with charities and difficulties in charities. That helps us inform our guidance development, helps us with our regulatory approach, assists us with identifying risks, and in certain circumstances, interventions with the charity concerned. So please do, as a trustee, use the opportunity to report serious incidents to us on a timely basis. In terms of keeping people safe as the restrictions are altered or amended, please do consider the impact on beneficiaries around implementing social distancing and reopening premises for business or for staff to attend to deliver charity services. If there are any safeguarding incidents, then please do again alert us through the serious reporting incidents framework. In terms of working with third parties, that's quite appropriate for charities to do, and we provide supportive advice and guidance about how best to do that. As you can see from the slide, there's a number of considerations to take into account, but it's quite an appropriate way for charities to deliver services to beneficiaries at this time, and to indeed raise funds where you're covered by a fundraising agreement. Please refer to CC20 if looking at fundraising. In terms of other updates, we've updated guidance for independent examiners to reassure them that they can carry out an independent examination during this difficult time, and given them some tips and advice about how to do that. We've also updated guidance for auditors and examiners on reporting matters of material significance to us. Financial planning during COVID-19, we recognise that many charities are struggling with fundraising significantly disrupted, some bearing costs of cancellation for fundraising events and for increased costs. There are, of course, sources of government funding which may be accessible, or government loans, so those schemes are well worth looking at. And please do view the DCMS and .gov pages for further information on financial support. NCVO have also got an excellent page which links through to areas of financial support to the charity sector. In terms of our advice to charities, we've got a three-step approach set out for financial planning during the COVID-19 circumstance. It's designed mainly for small and medium charities and reassures you about the steps to go through in terms of assessing the current situation, reviewing expenditure and reviewing income, and then planning for the future. But we commend it as a resource generally as well worth a trustee discussion. In terms of developments in hand, the Commission has a number of areas of development around our advice and guidance. We're looking at the experience of serious incident reporting in the light of the pandemic. We're planning to tweak CC40 to reframe it around our experience of the pandemic. CC8 internal financial controls are being updated for digital commerce, including, of course, digital banking. And we have a number of fraud alerts. This is continually updated, the fraud pages. We work with third parties as well. And there are a number of free resources, including webinars that are available through that link. So I do commend that to you, along with any resources from Charity Finance Group that are also extremely useful. In terms of accessing all this advice and support, we continue to maintain the trustee helpline in normal working hours, Monday to Friday. You can also follow us on the web, of course, and you can contact us with advice, requests for advice and guidance through our website web form. Thank you very much for listening.
So thank you very much, Nigel, for the presentation. Just to confirm that there were slight technical issues there, it appears, and many of you couldn't see the accompanying slides to the presentation. Just to say, we will be able to send those out afterwards with a link, so you'll be able to access those in your own time. But now you'll be able to ask any questions you might have regarding the comments Nigel have made, or more broadly of the Commission. So I would encourage you to do so. I'll pick out any questions that you might have, and it will be to his colleague Jenny Stewart. So please do take the time to ask some questions. It'll be a good opportunity for you to ask the Commission about any concerns you might have. Just give it a moment or two for the questions to appear. Okay, so in the meantime, while you're thinking of these questions, we might pass on to Nazir Hashemi from our audit partners Crow, who'll be able to talk you through some of the concerns one might have around COVID-19 and some of the tips that they've got around financial reporting issues for charities during this time. So I can pass on to Nazir now.
Good morning, everyone. Thank you, Richard and Elizabeth. So what NCVO and CFG wanted me to discuss with you today was two parts, and I should have actually reflected the two parts on my cover slide, so apologies for that. I'm going to rattle through some financial reporting issues that you need to think about, but connected with that, and you will see how I will seamlessly go into it to think about some of the financial management issues. I've only got about 10 or 15 minutes, so this will be a quick canter through. There's a number of challenges that COVID-19 poses in relation to financial reporting. And the first one of these that I just want to discuss with you is around income recognition. You will all know the golden rules, as I call them, of income recognition, which we've got right at the top of that slide, which is around entitlement, probability and measurement. And this is the general rule that you still need to consider when you're thinking about income recognition and the impact of coronavirus on income recognition. So as you know, you will recognize income when you're entitled to it. So that means you have the control or right over that asset. There's probability of receipt, so it's more likely than not that you will receive it. And then finally, it's capable of measurement. And in most cases, as a result of coronavirus, the entitlement principle won't change, but cancelled or delayed activities may lead to the charity not being entitled to the income. Probability of receipt also needs to be carefully considered for things like debtors or receivable, because these may become less certain. And then finally, measurement can be more challenging as asset values will have altered and dropped in most cases. The time taken to complete or perform under a contract may be uncertain, etc., etc. So you do need to look at that, those three criterion through this new lens. What I've done on this slide here, I've listed the typical areas that we're seeing discussions with clients. The first one of this is around the coronavirus job retention scheme, which Richard also mentioned. And the accounting treatment of this has been subject of some debate in terms of how do you capture this. On the next slide, I'll share with you a link to our guidance note, which actually picks up all of these things in detail. So I'm not going to go through it in detail, but the principle agreed is that in charity accounting, we don't have netting off. So you won't be netting off the income with expenditure. That's the first thing. So you capture the income separately from the expenditure. And then the second question we get asked is, can you account for it when you become eligible, or should you wait to receive it? In our view, you can account for it when you believe you fulfilled the eligibility criteria, in the same way as you would do with gift aid payments, for example. You don't wait to receive it, you account for it when you're entitled to it. And then what I've said there is you would match it with salary costs. Now, you all know better than I do that there is no principle of matching, so we're not suggesting principle of matching, but what we're saying is the amount that you're entitled to in the period that your accounts preparation is, of course, the equivalent of the salary cost that you are claiming the amount for. And then the other area you need to think about is with regard to events. What will happen with events? Well, some events have been cancelled, some events have been postponed, some have been converted into donations. You need to go back and look at the cancellation policies, but importantly, you need to consider the impact of coronavirus on your financial year end, and whether it's classified as a post-balance sheet event or not, because that then determines whether it's an adjusting or a non-adjusting event. Now, it's accepted that for 31st of December year end, coronavirus is a non-adjusting event. That means you wouldn't change the valuations in your accounts, you would just make post-balance sheet disclosures. But you just need to consider it in light of that. And then with regard to donations and grants, what you need to be thinking about is the likelihood of receipt, particularly in relation to donations. But with regard to grants, you need to go back and look at things like, if these are performance-related grants, how much will you be entitled to, depending on how much you've performed under that grant, or whether there are any donor imposed conditions, which would mean that it would change your entitlement criteria. Contracts, again, it's a bit like grants. You would have to just look at the conditions on the performance and make sure that you're entitled to the income that you would want to put through your accounts because you've met the performance conditions. In some cases, there have been no cost extensions, and again, you need to reflect that. And then finally, with regard to legacies, now legacies is an interesting one, and in the guidance note that I'll share with you in a moment, the particular sort of specific guidance that we've got on this, you will need to think about legacies, but this is mostly around valuation and timing of legacies. And again, it depends on the year end that you've got with regard to the accounts that you're preparing. But once again, you would need to go through entitlement, probability and measurement. But it is thought that some legacies, valuations of these legacies over time might be impacted as asset values have fallen, etc. That's a quick canter. Underneath here, I've shared with you a link to some guidance note that we've got on income recognition. So if you have got some sort of more detailed elements you want to consider, I do suggest that you look at that insight piece that we wrote some time ago. The next areas that you need to think about are on this slide. So if I take the ones on the left-hand side first with regard to commitments and liabilities, the golden rule, if you like, for commitments and liabilities are around obligation, when you've got an obligation to make a payment, when there's probability of payment, and again, when it's capable of measurement. So a bit like income, but of course, different in terms of the nuances there. And for charities, and the SORP is quite clear and describes this, you will have, and this is comes from Financial Reporting Standard 102, there is this concept of legal versus constructive obligations. Legal obligations are the obvious, it's legal. Constructive obligations are where in the mind of the recipient there is an obligation that you will fulfill. I'm sort of speaking very broadly about this, but you get the gist of what I'm saying. The area that we really see constructive obligations is around grant commitments, and particularly multi-year grant commitments. So you do need to go back and look at both your legal and constructive obligations and consider these in the light of COVID. The other area you need to be thinking about is leases and onerous contracts. And whether with regard to these, there are any terms or stipulations that you need to be thinking about. And in particular, I'm thinking of charities where you've got a number of leasehold properties or contracted facilities or services. And you need to think whether, as a result of COVID, any of those leases have become onerous contracts. Now, onerous contracts require you to then actually account for that within your financial statements. It is quite complicated, the rules on onerous contracts. So I'm not going to go through this in detail, but I'm just highlighting for you that you do need to consider this where you've got extensive leasehold properties. The next area to consider is around pension liabilities, and this is particularly important for those charities with defined benefit schemes. You need to be making sure that the current bond rates and yields and the estimates and judgments that are being used in the calculation of the pension liabilities reflect those that the organisation thinks are correct. That's no different from before. The impact of coronavirus may be to actually reduce or rather increase the pension liabilities for some charities. And the impact of this for some might be that you will end up with a negative balance sheet. Now, the Charity Commission some time ago published some very good guidance with regard to negative balance sheets as a result of pension liabilities. And they emphasize in there that what's really important, and you should capture this, especially in your trustees annual report, and explain it and use it to explain to any donors or funders, is that it's the cash flow requirements to meet that pension liability on an ongoing basis that are important, and not just the size of the pension liability at a cut-off point of a year end. The next area for you to consider is around gift aid payments from subsidiaries. Now, this is a little bit complicated. Companies Act requires a payment from a company to its members when there's sufficient distributable profit. And we usually calculate this by reference to the company's relevant accounts. So we use the last set of audited accounts as being those relevant accounts. But there is also a principle that a company cannot lawfully make a distribution out of capital and must consider this at the time of proposing the distribution and the time that the distribution is being made. So not just when you're sort of relevant accounts at the year end, but you also need to consider the affordability of this payment from the subsidiary to the charity at the time that you're making the payment. And you must make sure that the company is solvent at the time of making the distribution. I mentioned this a few times, but there is the URL at the bottom of this page for you to click on later and to look at all of what I'm saying in a lot more detail, and we do explain all of this. And then finally, financial covenants, finance covenants. The change in asset values and activities may mean that for those of you who've got loans or overdrafts with covenants, that you may not be able to meet those covenants. And this can impact, obviously, your discussions with the bank, but also could impact your loans disclosure. If you've got loans greater than 1 year, but you haven't been able to meet the loan covenants as at the end of the year, this may, and I would say is, probably disclosable as a loan due within 1 year, which can suddenly turn your net current assets into a net current liability position. So if you do have loan covenants, make sure that you are tracking this and you're having conversations with the bank on an ongoing basis. On the right-hand side, I've put up valuation and impairments. I'm just going through these very quickly. With regard to intangible fixed assets, you are required to do the impairment test annually. So make sure that you have looked to make sure that as a result of corona or anything else, that intangible asset has not been impaired. With regard to tangible assets, you only need to do an impairment review if the condition for impairment exists. And again, these are quite standard conditions, and they are within FRS 102. And I think the charity SORB mentioned these as well. The area that I really want to talk to you about is the valuation of tangible fixed assets, because we're finding that this is becoming a subject of many conversations with clients. It's not really a matter for 31st of December year ends, but we've started coming across this for 31st of March year ends, where there was uncertainty as at that year end, and there will be subsequent as well with regard to the valuation of those assets. The key here is that the valuers, spurred on by RICS, have started putting in a valuation uncertainty paragraph in their valuation report. RICS, which is the Institute for Chartered Surveyors, has told all valuers that they should put this in, but this presents a problem for both you as preparer of accounts and for us as auditor of accounts. And it means that you need to make proper disclosure of this valuation uncertainty in your accounts. And in some cases, it will require us as auditors to emphasize this in our audit reports. With regard to investments, again, this will be a matter of fact, but actually some investment values have taken a tumble as a result of COVID. If you are a 31st of December year end, that just requires a disclosure of fact with regard to the post-balance sheet event. 31st of December, your asset values would have been impacted in any case. But you may also want to make additional disclosures around the investment valuation. The key point around this investment valuation, though, that I want to make isn't even about financial reporting, is when we're looking at financial planning and going concern. Don't forget to account for a fall in value of investments when you are doing that review for your going concern purposes or for your planning scenarios. Stocks, again, this will depend on the asset life or shelf life, but that may have taken a hit, so you need to assess this. Debtors is an interesting one because, and again, we've disclosed this in detail in the financial reporting guidance note I've put here, but you really need to think about the valuation of those debtors as at the end of the year and whether conditions existed as at the year end, which in light of COVID have shed a light, and therefore those asset values need to be reduced or not. It's very complicated, but we've disclosed it there in the guidance note for you. Moving on very quickly to going concern. This is what I, as an auditor, am spending the majority of my time talking to clients on, and I'm probably doing 1 or 2 of these every day at the moment. So what do the standards tell us about going concern? I'll just read it out to you very quickly because I just want to emphasize a couple of things. It says an entity is a going concern unless the trustees intend that the charity will cease its activities or has no realistic alternative to do so. In assessing whether the going concern assumption is appropriate, the trustees are required to take into account all available information about the future, which is at least but is not limited to 12 months from the date when the financial statements are authorized for issue. The emphasis, and the italics are ours, is around 12 months, a minimum of 12 months from the date the accounts are authorized for issue. So that's the date for signing of accounts. Now, the international auditing standard that talks about going concerns was updated recently. It won't be applicable for most year ends that we're working on at the moment. Nevertheless, the Financial Reporting Council have emphasized that the new principles of ISA 570, as it's known, should be borne in mind by both boards and auditors. And the principles in that are that boards and auditors should be a lot more challenging of management's assumptions around the going concern assessment basis of preparation of accounts. And there should be challenge, there should be consideration with regard to what you're looking at. And whilst it says here a minimum of 12 months from the date the accounts are signed, I have to say probably most auditors and boards would want a period exceeding 12 months because of the current uncertainties and the huge impact of those uncertainties on the future activities and the future strategies of all organizations and not just charities. So I would say you need to look at least 18 months. Some are doing 2 years, that's good, but of course the longer the period under review, the more uncertainty there is in there, and therefore the more challenge you will have in it. But what I'm trying to emphasize is that don't just look at 12 months, look at a period beyond that. That is what the standards require you to do, and that's what the Financial Reporting Council have emphasized. And the final bullet there is around what the Financial Reporting Council think, which is that companies will need to disclose more material uncertainties in relation to going concern in the current circumstances. And I'll pick up on that in a moment. Trustees' annual report is probably the other area that I, as audit partner, am spending quite a lot of time looking at with my clients. And again, we're guided by this both from what the Financial Reporting Council have said for boards of companies, and many charities are companies, but nevertheless, the principles are the same. But what they emphasize is really important, and I can say, as someone actually reading these trustees' annual reports day in, day out, you do need to have a discussion of key impacts of COVID-19. You can either do this in a separate section and or weave it into the different elements, and I'll just quickly flick through those with you in a moment, of your trustees' annual report. But make sure your discussion of those impacts are quite visible. Make sure they're not buried deep into the set of accounts. I was reviewing a set of accounts last week, and I probably got into page 30 before they started talking about COVID. I know why that is, because obviously, you know, this was a December year end, that trustees' annual report was drafted quite some time ago. But as I sit here today looking at that trustees' report, and when it's published, the readers will wonder why there's no discussion of the most important event that is happening at the moment. So do think about making your accounts as contemporary as possible. The areas that I think you really need to focus on are in the financial review section and in the risk section. With financial review, don't forget you're reflecting back. So you're looking at what happened. And for most of us, whether you're December or March, the impact of COVID on those sets of financial results wouldn't have been huge. It's actually the impact going forward. But nevertheless, if you were a charity that was deciding to spend more than you received because you were holding too much reserves and you were spending down those reserves, If a reader is reading it today through today's lens, they may think that you were foolish to do that. So explain it to them. Explain why at the time you made this decision, this was the right strategy for you. So just think about it a bit differently. Risks is really important. It's obviously the risks of the organization at the time of the preparation of the accounts. But I don't think you can write a good trustees report without considering the risks of COVID and actually updating those risks. Now, some charities are putting that in a separate paragraph to the rest of it. Some are doing a separate paragraph, but then weaving it into the different risks that they talk about. It's up to you how you do it, but do think about it. Reserves policy, again, your reserves policy, you will need to think about your reserves and how your reserves will be used and how your reserves policy will now have to change as a result of COVID. So do think about that disclosure. Going concern, I would expect to find in most sets of accounts a paragraph in the trustees annual report, and indeed for most charities in their accounting policies around going concern. The Financial Reporting Council have been very clear that you need to disclose your judgments, your estimates, and the assumptions that you have made about the impact of COVID on your business in your accounts. And the reason they're saying this is that no one really knows what those, how those uncertainties will impact most organizations. No one can tell at the time of writing reports the impact of the social distancing measures. Therefore, the assumptions that you have used in order to make your going concern assessment should be disclosed as transparently and as a balanced disclosure as much as you can. And then finally, future plans. Your future plans will have changed because of coronavirus, and you need to make sure that you discuss this and you explain where you are in your thinking about this. Post-balance sheet events, I've mentioned this a few times. You do need to disclose post-balance sheet events, both in your trustees annual report and in your notes to the accounts. And I'm not going to go through that in any more detail because we've already discussed this. So just seamlessly going on to the financial planning aspect of all of this. I think it's safe to say that the future is uncertain, but there's many possible impacts of what the future will hold for all of your charities. I've put on the right-hand side there what we're seeing as the different phases that charities will go through. And those are all discussed, by the way, in the guidance note that I've put the URL for there, Managing in Uncertain Times, which actually we wrote quite some time ago, but have updated in light of COVID-19. So the first action for most charities and organizations has been to survive. So they've everyone has been sort of looking at their business plans and thinking, what do we need to do to survive? The next step in this journey will be to adapt not just to the social distancing measures, but to the new normal, as people call it, to the new world post-COVID and what that means for your different charities. I think to be successful, charities will need to collaborate and collaborate more. And this will be around collaborating with other charities, perhaps, other companies, etc., in order to be able to give the impact that you so desire for your stakeholders and for your beneficiaries. And then the last but not least, and the most important element of this is around planning for success. So we need to go beyond survive, adapt, collaborate, and actually plan for success and actually think about what the future will look like and what that means for each of the charities. Some charities have started things called like plan ahead teams, which think about the lessons of the current working environment, or the changes that need to be made in light of the changes to business model, in light of what they have seen and what they expect to happen going forward. But the key emphasis, as we say on this slide, is around liquidity, cash and reserves management, strategy and scenario planning, governance and decision making, which needs to be very agile in times like this, and you need to make sure that you've got the right people at board and management level so that you can be nimble and to make the right decisions at the right time. Risk management is really important in these uncertain times, and making sure that you've updated your risk registers. Some charities have actually got a separate register for the impact of COVID so that they can track those and communicate with their boards in that way. And then finally, around structures, operations and business models, and thinking whether any of those things need to change. And I know that there's quite a lot of charities that are thinking about this. So charities that had lots of offices around the country, but now can see that actually they don't need to have so many offices. So that will make a change to the structures and operations. But the important thing is to focus on the business models. All charities have business models. You need to make sure that your business model is resilient to withstand the shock that you've seen now, but also going forward. Just two final slides from me before I finish it off. The first one is around liquidity and reserves, and I sort of referred to this on the last slide. Just some tips from me, and these are obvious, you will all be doing them, but I feel better if I just talk about them very quickly. The first one is around making sure that you link your cash management with your risk management and your forecasting process. And that's really important right now when we are living in such uncertain times, and the number of risks that are facing each of the organizations that you work with are many. So you need to make sure that you've actually considered those risk factors when you're doing your forecasting, and you go back to your cash management. When you're looking at your risk management, don't look at each of the risks separately, but think of what we call risk cascades or risk contagions, and ask the what if questions. What if this and this and this all happen at the same time going forward? What if my fundraising falls, my legacy values fall, and I don't know, I'm not able to perform under those contracts in the way that I was? What if? And think about risk cascade and the impact of all of those on your forecasting and your cash management process. Think about your reserves. Think about why you're holding reserves. A lot of charities have put a lot of their capital programs on hold or discretionary spend on hold. Sometimes those were matched by designated funds. If you are actually putting those on hold, not going to do them for some time, is this the time to release some of those designated funds? Did you have rainy day funds? If you had any rainy day funds, is this the time to actually think about the appropriate use of those rainy day funds? And then finally, it's about thinking about the now and the future, and the impact of the downturn on the operations of your charities, on your fundraising, on your legacy values, on your trading. Think about how long it will take for you to be able to catch up with some of the things that you've been thinking about. And then finally, it's around strategic thinking. And again, I see a lot of charities doing this. You need to go back and you need to revisit your strategies, especially if you did them quite some time ago. You need to think about whether actually your strategies are fit for purpose in light of the challenges of the current environment. Will you be able to achieve all the things that you thought you wanted to achieve when you set your strategy? Will you be able to deal with this uncertainty, factoring in that the probable is difficult? You need to develop, as we say on this slide, tactics on the premise that there are several possible outcomes which are possible. And what organizations in these situations tend to do is they start doing scenario planning. These aren't forecasts, these are scenarios that people build. Usually people start with, I don't know, 2 or 3 scenarios, but then perhaps move up to a 4th scenario. And these are not forecasts, as I say. They're not meant to be too simplistic, but they're enable you to monitor and build in triggers for actions, and enables you to bring in different perspectives from the whole organization with regard to the things that you need to do in your strategic thinking as you move forward. That's all I wanted to say, Richard. Thank you.
Well, thanks very much, Ms. And there's multiple bits of interesting advice and issues covered there. And we have had quite a few questions for both yourself and the Charity Commission. So if we go through those now, and it should be noted that please do ask any questions you might have of either speaker, and we're more than happy to take those as well. So we'll start with one, and it's around reserves. You did touch on that towards the end of the presentation, but it involves both yourselves and the Charity Commission, and it is the current thinking about the level of reserves that charities should consider holding from the Charity Commission, and what is your view about using reserves to pay costs now and having reduced ones longer term?
Do you want me to go first?
Yeah, by all means, Nigel.
Yeah, thanks very much for that. Yes, we do, on the COVID page, on the Commission's home page, which will be a link that will come through to delegates, talk about the need to deploy reserves now, because clearly with the stress that financial stress charities are under, those charities that are fortunate to have reserves or expendable endowment, which is not technically reserved, may be able to, subject to any restrictions on the expendable endowment, be able to use that to cover some of the unavoidable costs that this disruption is causing to the charity. Clearly, there's sort of medium-term planning impacts of that, which Nazir's talked about. One is strategically, what is the level of reserves that you do need to maintain your strategy going forward in the light of any changes you're going to be making to the operations of the charity due to the effects of COVID in the near future, and on your medium term, depending on the resilience of your fundraising activities, your donor base, and your income. And secondly, of course, in terms of the ability to replenish reserves, and that will affect the degree of risk involved around drawing them down. But as a regulator, we think it's quite prudent and appropriate thing for trustees to do, to draw on the reserves if they have them. If you haven't got reserves, then it's clearly an issue around exploring whether any other funds where restrictions might need to be revisited, which case in contact with the Commission, or alternatively maybe facing more difficult decisions around collaboration merger, or perhaps sadly even closure. But that's best done with careful thought, and the best time to start that is now.
Is there any additional comments? Nazir, are you on mute by any chance?
Sorry, am I back? Hello?
That's right.
Hi,
That's right.
sorry. I was talking away. I said I agree with everything Nigel was saying. And as I said on one of the slides, you do need to go back and look at your reserves and your reserves policy and actually unpick those and really consider why you were holding reserves and how you need to use them going forward. And for me, it's around making sure that you've linked your reserves into your consideration of risk and what the consideration of what the future will hold. Someone has just posted a question that says, is there any guidance on the level of reserves felt reasonable going forward? And that Nigel and I haven't picked up on this. I'll start answering this and then Nigel can come back in if he wants. The level of reserves you need to hold, the Charity Commission guidance CC19, if you want to go and have a look at it, actually covers this. There is no sort of minimum level of reserves that you need to hold, and the guidance is quite clear on this. You need to have a level of reserves that is fit for your organization and fit for the activities that you need to do. For me, it comes as when you're thinking, you have to think about the business model of the charity. How does that charity earn its money? How does it spend its money? and what does it need to save, if you like, in order to be able to carry out some of the investments in the future that it wants to do with regard to some of its activities. So you do need to go back and reflect on all of those. I don't know, Nigel, if you want to answer from a commission perspective on level of reserves that you feel is correct going forward.
I can support what you said, Nazir. We regard it as an area of trustee judgment and one that needs to be kept under review for the circumstances of the charity. So apparently similar charities could have very different policies depending on their prospects going forward, their decisions around their activities, and the current financial context they're operating under.
The way I look at this with my clients when they're trying to refresh or actually think about this, I say go through. Charities are complex because most of you aren't sort of factories making widgets and selling them. You raise your income through multiple sources, and quite often your activities are diverse. You might be campaigning, you might be actually delivering services, etc. So what you need to do is to go through and understand each of your income sources and think about sort of those income streams going forward and around the risk factors in relation to those. Sensitize them. Think about how likely you are to receive them going forward. And then do the same with regard to your expenditure. In most cases, expenditure is, you know what you need to spend, but you may be able to curtail some expenditure, as some charities are at the moment, in order to ensure viability. So you then need to consider that part of it. And when you look at those together, you can come up with a more comprehensive reserves policy. Richard.
Thanks, Nazir and Nigel. And there is another question for the Commission here, which is on a slightly different topic. And it's, could there be a bit more guidance in terms of steer of how trustees should go about making a decision to report a serious incident in the current context? So I think, Nigel, is there current guidance available, and what would you recommend around that?
Thanks, Richard. Yeah, we're looking at the experience of the pandemic, and I understand we're planning to issue some further clarifications about what we'd like reported, because clearly many charities are facing a fall in income, but not all of them. I'm pleased to say not all of them potentially are facing a situation which gives doubt about their ability to continue operating. And it's the ones which are facing existential, issues about whether they can continue operating on severe disruption I would really like to know about, so we can understand the full impact on the sector. So yes, we have some developments in hand, and I will take that back to my colleagues at the Commission to note that this issue came up on the webinar. Thank you.
That's good to hear, Nigel. There's a question I believe was partly addressed in your slides, Nazir, but if we can perhaps touch on it again, then it's, should fixed assets like property be revalued at this time for balance sheet reporting?
Only if you've got a policy of revaluation, otherwise you wouldn't need to. And if that revaluation falls within this year, I think you may want to do it for operational reasons. It does cost a lot of money, but as I said, actually, thinking about it out loud, I hadn't really thought about this question. Given what I was saying around that valuation uncertainty that valuers are putting in, I don't know how likely you are to get comfort with regard to that valuation. On a set of accounts I was looking at a couple of weeks ago, the valuation uncertainty they reckoned was plus or minus 3%. Now, obviously, if it's plus 3%, it's fantastic. If it's minus 3%, it's terrible, but also quite material for accounts. And this was a organisation that does sort of need to disclose that valuation. So you would only need to revalue if you've got a policy of revaluation, or you want to have it for some sort of operational perspective, or if you've got a loan or covenant or something like that, you may then want to revalue it for that reason. Richard.
Yeah, that's a really helpful answer, and hopefully that addresses the
is that if you've got investment properties, the SORP requires, because they're investments, they would be at market value, but that Nazir is referring, of course, to functional property you're using to further the charity's objects. But just to note that investment values may be hit, and that's one of the issues I think Nazir referred to.
Yes. Thank you, Nigel.
Yeah, that's right. That's really helpful to have that additional comment. We have multiple other questions. I'll get through a few on different topics as well. And so one is, should we make a provision for any redundancy payments, whether or not there is a current likelihood of redundancy for staff eligible for those payments? So we'll start with Nazir and then move on to Nigel.
It's an excellent question, and one that we have irrespective of coronavirus. When people are thinking of making people redundant, you need to go back and think about what I was saying on the slide around the liabilities, and we covered this in the guidance if you look at it. It's really around obligation probable measurement, and it's that obligation point, whether you had an obligation as at the end of the year with regard to those redundancies, that would mean whether you would make a provision or not. It's covered in the standards through thinking about restructuring provisions. I do have a guidance on this if whomever wants to get in touch, and I can send you the detail of it. But it's not enough for you to have thought about the redundancy. You should have communicated either to the individuals or that class of individuals that you're going to make redundant in order for you to be able to make a provision as at the end of the year. And you should have done that before the end of the year. And then, of course, you need to look at sort of probability and measurement, but it's usually around that obligation point that you need to focus on. I don't know if, Nigel, you want to add anything?
Only that it is not a provision for the very good reasons you mentioned. This would allow flexibility if you have reserves, charity function tax reserves, that you can make a designation of the segment of restructuring. But you might want to explain that sentence.
Sorry, I can't hear you, Nigel. If only it says so, I can't hear you to explain it. I'm sorry.
There may be opportunity to construct a designation of the reserves for a future restructuring, which hasn't been announced yet.
Yeah.
But of course, they need to be handled sensitively around disclosure because of the impact of individuals if the news leaked out in an unplanned way. So that would be a flexibility available.
Yes, so Nigel is, as you all heard, saying you can make a designation of your reserves, which isn't a provision. So it doesn't come out the total reserves, it just designates it. But the sensitivity point is a good one. You can call it something like restructuring provision or something like that to make it more sensitive. But the point on making a provision is really around creation of that obligation as at the end of the year that would allow you to make that provision. Richard.
Yeah, I think there's some really helpful there. And again, just to, if for whatever reason you can't hear one of the speakers, please do let us know, and we'll hopefully be able to reiterate what they've said for everyone to hear. The next question regards the coronavirus job retention scheme, and it's, is there a tool available that will help calculate our job retention scheme claim? Now, fortunately, there is, and it's produced by government, so I'll send a comment in the chat box with that tool, and so everyone should be able to access that now. So please do look at that tool if you're having difficulty calculating your job retention scheme claim. The next question is around serious reporting. We have made a serious incident report to the Charity Commission re COVID-19, then updated this report. The Charity Commission are happy with this. Should this be mentioned in the annual report? So if we start with Nigel and then perhaps move to Nazir.
There's no mention reports in Steve's annual report because
quite difficult in hearing there, Nigel. Is it possible to repeat the answer, if that's okay?
There's no obligation to talk about serious incident reporting in the trustees' annual report as such, as the two frameworks are separate. What is really at the heart of it is the issue itself. So, for example, if the issue had operational effects which were of wider interest, you might want to talk about the effects on operations and how you overcame the challenge, rather than provide the details of the report you actually made.
Yeah, I think that's helpfully cleared that up. The next question is around loan finance, particularly. So what is the view of the Commission, and perhaps I'll add Nazir into that as well, of charities taking government-backed loans to gather short-term liquidity that must be repaid, as grant funding can't usually be obtained to repay the debt?
The loans, of course, will be subject to eligibility criteria, and please look at the government website for that. As mentioned, they have been changed as a result of, I think, of NCVO and others lobbying for some change, as the loans were originally designed for for-profit entities. We have no difficulty with people taking loans, but so doing, you need to be able to plan for repaying the principal and any interest that may be due on the loan. I can't really comment on whether third parties will be able to fund those if you can't obtain grant or other external assistance to meet your interest obligations and assist in repaying principal. Then you'll need to look to other sources of funding or reserves. If you were taking out a loan that you were unable to repay, then that would be a difficult decision to make, and one that I think arguably indicates that the charity perhaps sadly is not viable, and that instead of taking out the loan, you need to think about how to plan an orderly wind down or transfer of activities to others, which would be a difficult decision, I accept. But taking out a loan that you had no intention of repaying would put the trustees in a very difficult position and perhaps give us some concern about the decision making. Over to Nazir for any thoughts.
Just to say, I mean, I can't give investment advice, so you need to decide whether you do want to take government-backed loans or not, and affordability and being able to meet the terms of those loans will be key to your decision. I am seeing more and more charities actually taking advantage of the government-backed loans. Even ones, and I thought someone had raised the question on this earlier, but I've lost the question now, even those that have their own investments, for example, because what they're thinking is that they'll hold those for a rainy day, but for short-term liquidity, because if they do the sums and the terms are favourable, etc., it's better for them to actually take out the loan. But the question of repayments, if you're in a completely restricted environment where you've got just grant funding that you can't generate surpluses on, then you will have problems meeting those payments. I don't think I've got anything else I want to say on that. Oh, just one other thing I did want to say, and Nigel can come in on this. Sorry, I forgot. If you are going to take any loans or anything backed on the assets of the charity, there are some rules, and Nigel knows these better than I do, with regard to making sure that you've had independent advice, and or if you need to get commissions permission to do this. Nigel, do you just want to cover that? It's covered in one of your operational guidance.
Yeah, I think it's also covered through the COVID page, where we can use our powers sometimes to assist in terms of our trustees confirming they're able to offer charitable assets as grant security or loan security in this case. Yes, there is guidance on the website. It's a reasonable decision to make. Then we'll no doubt support trustees in making these difficult decisions, but look at the terms of on basis on which the assets are held, whether restricted or unrestricted, and the form of guarantee or security that's being provided. In most circumstances, I think trustees will have the ability to enter into certainly loan arrangements and guarantees, mortgaging, if you like, or securing assets without requiring our consent. But do contact the Commission. It involves the trading subsidiary, for example, if you're guaranteeing the debts of a related entity.
So a really response there. A question here about the local authority discretionary grants. So I'm struggling to think what sort of charities are eligible for local authority discretionary grants, which have recently been agreed. In order to give some examples, that would be hugely appreciated. Now, it should be noted that this is, I believe, on the Small Business Grant Fund, which was a one-off grant of £10,000 for eligible businesses. Now, some charities are included in that, and as already mentioned, it is discretionary, so it's dependent on each local authority. Now, the best advice we can give is to check with your local authority on whether or not you are eligible. what I'm going to do is post into the chat box a website which provides a list of relevant pieces of guidance from each local authority, which should provide you with some help. So do check under your local authority the guidance and see if you might be eligible. So that's been posted now. There is multiple other questions, and please do keep them coming. We do have more time for them. And it's what is the timing for revisiting values of assets in legacies? So perhaps we start with Nazir and then move on to Nigel.
I don't think I don't know if Nigel knows the answer to that. I don't know where the questionnaire is going with this. Do you, Nigel?
If it's to do with your broken estimate, then charities encourage you, whether you have pipelines, to consider using a portfolio approach to estimating the value of legacies. And if this is to do with that,
sorry, Nigel, we can't hear you. Could you repeat, please?
if it's a charity that's operating a pipeline where you look at estimates for likely value of legacies, then the circumstances might be such you've got more current information about the value of those legacies, then it's a question about whether it's an adjusting or non-adjusting event. And I'd see it provided information on that in our talk.
Yes, so I understand now what the question is, and Nigel's helpful answer there. So you're asking about the timing of revisiting values of assets in legacies. It depends on the policy that you adopt for your legacy recognition, whether it's on probate or estate accounts, etc. But also, as Nigel says, with regard to the pipeline figure that you need to disclose, and that pipeline figure, the valuation in that would be updated right up to the date of signing the accounts, because that's in essence, as Nigel says, a post-balance sheet disclosure. On that guidance that I referred you to, financial reporting for charities, we do look at the sort of the impact of coronavirus on the valuation of legacies and the sorts of things you might want to consider.
Thanks very much for answering that. We have questions coming through, which is great. Again, please do keep them coming. One is, should a provision be raised for cancelled events now for possible refunds when not possible to convert to donations or to reschedule the event?
It depends on the year end that you're looking at and whether it's a post-balance sheet event which requires adjustment or not. So for most of the ones we're looking at the moment, which are 31st of December year end, because COVID is, as an event, is taken to be after the end of the year, they have still got it in their debtors and creditors, if you like, but we have clearly disclosed it as a note to the accounts. We've got two things in play here. One is the COVID as an event, and the other one is the impact of the social distancing measures on your accounts and when you became aware of these and whether these are before or after the end of the year. And that's what makes it quite complex in terms of whether it's a post-balance sheet event that you disclose or not. I don't know if you want to add to that, Nigel.
I suppose post-balance sheet event-wise, it depends on whether you've got deferred income or not. So, for example,
yes,
if the event was a December year end and the event was in April after the lockdown took place and you hadn't yet signed off the accounts because otherwise there wouldn't be any adjusting to do because the accounts have been signed by the trustees, they're still open in that sense, then you have the ability then to look at the deferred income you took in December and then abandon the event and say actually that income is not going to be receivable anymore because the event is not happening, and then you revisit the figures.
But the standards are also, the standards and the FRC guidance on this is very clear It's around whether the, and it's quite counterintuitive. I find it very counterintuitive, because you would think that with a 31st of December year end, where it's deferred income, that you would adjust the event, but the accounting standards actually don't support that. And it's whether the condition existed as at the end of the year. It's the same with regard to a debtor, for example, and whether the event after the end of the year shed a brighter light, as the FRC say, on the condition that prevailed as at the end of the year, as to whether you would make an adjustment for it or not.
That's a fair point, Nazir. So it's more likely to be a March year end than December one that'd be affected.
That's right. And even March year ends, it really depends on the impact of the social distancing measures on you. But actually, a March event, it will be a question of fact by then. But it's also around when you chose to cancel that gala or dinner or whatever. And the timing of that decision, which is why I can't give a very clear-cut answer. The condition has to have prevailed as at the end of the year, and then you can change the sort of estimation of it. It's completely counterintuitive, folks, I think. Because you would think you would have to change it because you're not going to get it, but it's not as simple as that. Really
useful insight at the end there, Nazir, as well. There is a question here. I'm quite intrigued. Perhaps the questioner can clarify this to see if I've got the right interpretation. And it's, how careful and what actions do charities need to take when receiving large donations in this difficult time? So I imagine there's quite a few things it could touch on here, but I'm interested in your thoughts initially, Nazir.
Yes, I saw that question as well. I don't know that the challenges are any different now to what they were before, and it really depends on what the donation is for and whether there's any conditions or restrictions, and whether you think that you will be able to fulfill them in light of the current conditions. And the reason I'm saying it's no different, you still need to do all the due diligence. You need to make sure it's not tainted. All of those things that you did before, you would still need to do now. I guess the only note of caution I would say is, and this is part of sort of the tainted donation rules and some of the other guidance, that you need to be wary that a large donation doesn't change the direction of the charity, and that the board, and as the commission says, it's the board, it's the trustees and only the trustees who can decide on the sort of activities of the charity within their objects, and that a large donation doesn't suddenly strategically change the direction of the charity. I don't know if you want to add to that, Nigel.
I suppose what you're saying is here, it's always reference to objects. Donation must be acceptable and further one or more of the charity's objects. Something like that.
We've never agreed as much as we have been today, Nigel.
Long may it continue, I say. So we have one or two more questions, then we'll allow speakers to make some kind of final closing comments before we come to an end. And it's here, and it's our financial year is in 31st of December. In light of COVID-19, we probably should think about a closure policy, including redundancies. Should that be costed out for our 2019 report, or is it not relevant for that year?
I don't know why you need to be, why should you probably be thinking about a closure policy? You would only really think about a closure possibility, a closure policy, if you were thinking of closing, I would say, and there were some conditions that made you think that you were looking at closure. Having said that, and this is the challenge when we're reading questions in writing rather than having a conversation about it. Having said that, a lot of charities do actually start by thinking what the minimum level of reserves they need if they needed to close down, so that they've got that as sort of in the back of their minds as a stepping stone for building their reserves policy. So I don't think it's a bad exercise, but it's I would ask, why is it that you want to costed. If you think that you're going to have to close, then you've got much more serious problems than just costing them out for your report and accounts. But as a mechanism for working out what the safety net of your reserves and mostly your cash needs to be, if you think you're going to face some difficult circumstances, then I think as an exercise, that's a good thing to do.
Any additional comments?
Only from a commission review, due to the disorderly collapse of Kids Company, 2019 charities reserves, to request that trustees consider this idea of contingency planning that the Zira already referred to, which isn't quite the same as deliberately putting in place steps to proceed to closure, but is idea to prudently allow sufficient resources if that difficult circumstance arise, or at least understand the financial challenges if you haven't got those resources available. So I support what Nazir has said, and that's the context for our guidance if the questioner was thinking of CC19.
You don't, and just rereading the question, should this be for your report and accounts? It's part of what you would do to think about your reserves policy and the future operational reserves that you need. And, it might be sort of one element of disclosure of your reserves policy, but it's certainly not the only thing.
Yeah, and again, if the questioner wants to follow up there and clarify something that might be useful as well, but hopefully we've addressed, I think, all the salient points there. We'll take our penultimate question now, and it's, are funding issues as a result of COVID-19 are forecast to happen in the autumn rather than now? Do you have advice for organisation like ours, where we cannot show a loss now, and they put in parentheses, we have had emergency funding, but are going to see a major dip later?
Sorry, could you just read me that again? I didn't hear the first part of what you said. I apologise. No,
of course. So it's our funding issues as a result of COVID-19 are forecast to happen in autumn rather than now. So I think it means there's going to be a delay in the issues around funding. Do you have advice for organisations like ours where we cannot show a loss now because they've had emergency funding, but are going to see a major dip later?
I absolutely. I think it's that's what I was talking about when I was saying that you need to think about the different elements and the different strands of this. For most organizations with a March year end where they had a good year because they were going to have a good year, you won't see the impact in the numbers that they'll be presenting. The impact is going forward for quite a lot of charities. So I don't know if you're an arts organization, you did roaring trade in the year to March 2020. Social distancing measures mean that all those venues have now been closed and they're likely to be the last to open. So I think you definitely need to make sure that you discuss this. And I talked about this a little when I was talking about trustees report and saying make it contemporary. You need to discuss it in your future plans, in the things that you will and will not be able to achieve, given the funding available to you. You definitely need to then discuss it in your risk. So, we've done some scenario analysis, and there are some organizations, I work with lots of art organizations, that are thinking about the closures carrying on or them not being able to open until March of next year, for example. So the loss, as the questionnaire says, is yet to come. And therefore, you do need to discuss this in your accounts. It really comes into the going concern bit and having those discussions at board level and with auditors when you're thinking about going concern, because that's the future piece, whereas the financial reporting is the past piece, if you like. Nigel, did you want to add anything?
No, that seems spot on.
Absolutely, and the questioner I think has covered slightly, but I think we did address that in the question as we took it. So I think the final question that I'm going to actually address is going to be, I think, addressed to what I'm going to ask Elizabeth to comment on briefly as well, and it's will funding be made available for additional work created by COVID-19? So I think it's an opportunity, I think, for us to provide a bit of information on what we're going to be doing as sector bodies, I suppose, in the future around trying to get additional funding for different organisations, and just some of the work we've already done, I suppose, to briefly say how different charities might be able to help and what other bits and pieces we're working on. So Elizabeth, do you want to briefly touch on that quite broad question, and let's see.
Yes, thanks, Richard. I mean, definitely the funding that the National Lottery Community Fund is distributing, both from its own funds and on behalf of government, is specifically about to support organisations that have seen an increase in their work and in demand for their services directly related to COVID. It's about organisations on the front line. I think there is also a longer term issue about, as Richard says, even once the crisis, as we get through the crisis, there will be organisations that are still seeing a huge demand for their services as a result of COVID. So we are talking to government officials, particularly in DCMS, about longer term support for the sector. But I think what it might sound harsh is that even if we do get further support from government, it will never be enough to help all the charities that are struggling. There will be questions around how charities themselves need to manage their finances, and there is a lot of discussion in the sector already about, resizing and reshaping, and I think that will be inevitable, so that charities can continue to meet the needs and the demand that they experience, but they'll probably have to do it differently.
Yeah, absolutely. I think that's a really kind of helpful answer to that question, and hopefully gives an indication of what we've been doing, what is available, and what we'll be looking to do in the future as well. We're drawing to a close now. The only thing left to do is to thank our speakers who've given excellent presentations and been able to address your questions excellently, I think. I want to, before we come to an end, come to a few upcoming events which both ourselves and NCVO will be doing to signpost you to. So on the 16th of June, we'll be holding a VAT tax and gift aid conference, which again will be hosted digitally. And on the 24th of September, CFG has a technical update conference, which is also digitally. On the 5th of June, NCVO has a webinar on board leadership, supporting your charity through the next phase of the pandemic, which I think will be very relevant to some of the things we've heard today as well. And the only thing left to mention, the final one, is on the 13th of October, CFG has our annual conference. We had to, of course, delay that given the coronavirus, but it will be coming up on the 13th of October. This will be sent to you in email following this presentation, as will all the slides from the speakers and a full recording, so you can address the Q&As afterwards. So thanks very much to the speakers, and we look forward to seeing you again at another CFG and NCVO webinar. Thank you.
Thank you.
Thank you.